Hey guys, Toby Mathis here, and today I'm going to be talking with John Strohmeyer, an attorney that we both been kind of active with some of these folks online that are pitching this illegal trust scheme in TikTok and Instagram and in YouTube, and we both deal with the fallout of the folks that actually listen to these folks. So first off, welcome, John.
Toby, great to be here. Thanks for having me on.
Yep, and we are going to be going over everything from what are these schemes, the 643 trust, the hey, I don't have to pay tax on it, what the ultra rich do and never pay tax, which isn't true, but we're going to go over what it is, what 643 actually deals with, why they're misinterpreting it, and when they say, hey, you don't have to pay tax, what they're actually misinterpreting and how that works. We're going to go over what the IRS is doing about it, because John and I both have experience with the IRS on these. And we'll show you kind of what happens to people when this happens, not just to the promoter, but to the people that actually engage in the transaction. Then we'll finish it off. If you know anybody who's been doing this, or if you've ever heard one of these things, A, put it in the comment, and B, share this video with them so that they don't make a mistake that comes back to ruin their life later. And so if that's good, we're going to dive right on in. So John,
Sounds good.
For people who are hearing about this the first time, what is this 643 trust and what are promoters claiming that it does?
So the 643 trust, 643 is referring to Internal Revenue Code section 643, which deals with definitions that are part of income trust taxation. And it can also be called non-grantor, complex, irrevocable, spendthrift, discretionary trust, or some combination of that. The short version is people think that by putting this magic trust into place, they don't have to pay any income tax on a variety of things, and kind of depends on who the promoter is. Sometimes it's no income on anything. Sometimes they just dial it into it's really just dividends and capital gains that you're not going to pay tax on. The short version is it's a too good to be true tax scheme where people aren't paying tax when they should be paying tax.
Well, let's break it down. So they're doing this big old pitch, and they're saying, hey, under certain code provisions, and they're pointing to 643, which I'll pull up here in a second. They're saying, hey, there's these cool things where, hey, if you allocate it to corpus, you don't have to pay tax. If it's, so if it's capital gains, you sell a house, you sell some real estate, somehow that now we don't have to pay tax on it at all, including the trust or any of the beneficiaries. And if we just call something extraordinary dividend, I've seen them do this where they have the trust held by or a business held by the trust, and then they go, oh, if that business makes money, then you don't have to pay tax on it because we're going to call it an extraordinary dividend. And they do it all under this code provision. Actually, let me pull that code provision up so people can actually see it, and we can kind of go through it.
Yeah. They're looking specifically at 643B, where there are two sentences, and they focus in on that second sentence that says, well, if the item of gross income that are extraordinary dividends or taxable stock dividends, or, if the trustee or if the fiduciary determines it should be allocable to corpus, well, then it's not going to be considered income. What they skip over is the sentence before that says income, if it's not preceded by the words, specifically here, taxable, then they're talking about a concept called fiduciary accounting income. Fiduciary accounting income, the problem and where we get this confusion is it's a similar system for talking about what comes in, but it is distinct from taxable income. And the way I think about it is we've got a 2x2 grid when we have a fiduciary dealing with income tax. There's taxable income, which it's just like you and me as individuals. Stuff we receive in a year, we're going to pay income tax on that the following year. Fiduciary accounting income is less concerned with taxable income, and it's allocating between just what's available for current distributions to current beneficiaries and what's being held for remainder beneficiaries. And go ahead.
No, I was going to say, just so people can follow, the trust makes money. And under this subpart, it's saying what portion is going to be included in distributable net income that's going to be taxable to the beneficiaries. So let's say John, let's use an example. Let's say that John has a client that sets up a trust, and there's a beneficiary, and every year the trust makes money, and maybe it's a simple trust where it just has to allocate all the income to the beneficiary. Or perhaps it's a complex where it's either the trust or the beneficiary is going to receive it. What this is basically saying, this code provision is like, hey, for simple trusts, we're going to let you allocate it to the trust corpus and pay tax on the trust and not to the beneficiary because the trust kept it, this is what's kind of weird, right? When you have a simple trust, isn't it that the beneficiary has to receive that income?
Right. Simple trust. Every time I give a talk to other professionals about this, I always ask if anybody's done a simple trust return. And usually it's they're too complicated to hit the target to be a simple trust. And so nobody really does it anymore. But yeah, essentially all the income has to go out to the beneficiary every year, and then they pay income tax on it.
And so when this provision, and I'll put it back up here just for a second. So when we're looking at this provision, and it's talking about these different types of income, and it's talking about subcharts, the subparts, we are talking about, is this being allocated to the beneficiary and taxable to the beneficiary automatically, or can we keep it in the trust itself and let the trust pay tax on it?
Right.
And that's really all we're talking about. But they misconstrue it and say, oh, it's not taxable because it's not included in this definition of distributable net income. Is that accurate?
That's about the way that they are describing it. It's accurate in, yes, that's what they say, but no, it's not accurate for not getting you in trouble with the IRS.
Yes.
And the thing, the underlying justifications of why they think it works varies. Sometimes it's not income, therefore it's not taxable income. Did see one recently where they said, well, because fiduciary concepts are much older than the Internal Revenue Code, then that has to come first. And the reality is, it doesn't matter first or second, because they're both being determined, and then you put them together for a concept of who that tax gets allocated, distributable net income. But
yep.
Yeah, it's just, we're going to have to run through both of them. It's not one after the other. It's you determine each and then use those to determine the results of who pays tax.
And I want to pull up, I'm going to find the reg here. So I'm going to pull up the reg here. And this is law, because this is one of the arguments you get from these folks is that, hey, the plain language of the statute says it's not includable in taxable income, and it's not includable in income for purposes of distributable net income. So it's not taxable to the beneficiary. It doesn't mean it's not taxable to the trust. And then they always say, well, the plain language, and the IRS misinterpreted it, and the courts, they always back us up. No, it's actually law. Here we have a reg. And I think it's pretty clear here. I highlighted the distributions of principal is being paid from capital gains realized during the year. Therefore, the capital gains realized during the capital year are not included in distributable net income, which is what the statute says. It's not included in DNI. And the $10,000 of capital gain is taxed to the trust. And this is a case where they allocated it, the capital gains, to corpus. And so when they say we allocated it to corpus and therefore it's not taxable, that is not true. They allocate it to corpus and therefore it's not taxable as distributable net income is true, but that does not mean that it is not taxable. Is that fair?
I mean, yeah, I guess to kind of sum it up in one word or in one sentence, in a given year, it's going to be taxable to somebody, whether it's the trustee, because it's either held in the trust or excluded from DNI, or it's taxable to the beneficiary because it was included in DNI and then distributed to the beneficiary. Somebody's paying tax on it in a year. There's no deferral. There's no non-taxable option.
Right. Now let's go over a few of these folks online. And I'm just going to pull up we have different names for these folks, but I'm going to pull up a few people. I call him Cowboy Hat Guy. Let's listen to what he has to say.
Why don't more people operate out of trusts? Short answer is because they don't know how. So I'm going to explain it in 3 steps. First, you need to set up a non-grantor, irrevocable, discretionary, complex, and spendthrift trust. Second, sell 95% of your LLC, not a C or S Corp, to the trust as a non-officer. Third, drive all the income into the LLC and pay the trust via K-1 distributions. Just like that, the trust deferred 95% of the taxes in perpetuity. Why don't more?
Okay, John, what the heck is he saying here? And for the folks that are listening, understand how this is going to interplay with what we just talked about.
Right. And so here he spelled it out, the non-grantor, complex, irrevocable, spendthrift, discretionary trust. Hitting the words.
That's mouthful.
He's saying that again, we're going to put everything in here, or we're going to put 95% of it. I don't know why he was holding back on 5%, but there we are. But presuming that you can then get your stuff into a trust and then not pay any tax on it, it's not going to work that way. The other thing that comes up is, well, how do you get it in there? You sell your LLC. Well, they're calling this a non-grantor trust, but the reality is, because this is someone where the economic substance hasn't changed between, whoever the person is creating the trust and the trust, like, you're still in control, you're still making changes. That's a grantor trust. And so it's going to be one not recognized for any sale. But the other thing you always see with these sales is we're going to sell it for basis. And that's going to trigger something we really don't have time to talk about, which is part sale and part gift transactions, where, something's happened. We have to recognize that for tax purposes. So what is it? And usually it's, well, nothing's actually happened.
Right. This is something you just hit on that I want to make sure a lot of practitioners are out there saying these guys still have control. They're still running things. It's a grantor trust, so all this is a moot point. And the IRS would probably take that same position. They would look at it and say, you can't just say something as a non-grantor trust and magically sprinkle some fairy dust on it and now it's non-taxable. A, that's not true. The trust still pays tax on its income. In fact, it's worse tax than you and I. It gets up into the high brackets, like boom. And
15 grand or so.
Yeah, it is really low before it's in the top brackets, and people don't understand that. But because they misconstrue these provisions on distributable net income, and they say, aha, it's not distributable net income, therefore it's not taxable income. Those are two very different things, and they misconstrue it. And that's what this gentleman is doing, cowboy hat guy, is he's saying, hey, if you have all that money come into the trust, we're going to call it an extraordinary dividend. And then because it's an extraordinary dividend, it's not taxable. And that is not true. It might be an extraordinary dividend, and you might be able to use some tortured theory that profits out of your business or somehow an extraordinary dividend, which is not what an extraordinary dividend is. But let's assume, arguendo, that they were correct. It just means that it's taxable to the trust, which is way worse than if you had received it.
Right.
Which, again, that's why this is so nonsensical. But these guys, their response, and I know you've had some comments with some of these folks, their response is, but the plain language. Well, we'll get into the IRS memorandum, et cetera, and what they say, which you should actually be listening to, and what the law actually says, which there's a reg on it, and it's pretty darn clear, and the fact that a bunch of people have been prosecuted. We'll get into all that later. I want to go over another one. I call him kind of stoner guy. Let me share this out so you guys can just see. There he is. And I'm going to play his video here as well, just to be fair.
True trustee. Most people are stuck chasing after income, but what they really need is a trust that holds that income. Because here's the truth that they will not teach you in school, on YouTube, or even at your CPA's office. Personal income is taxed. Business income, including LLCs and S Corps, is taxed. But trust income inside of a properly structured non-grantor, irrevocable, discretionary, complex, and spendthrift trust can be deferred 100% legally. Let that sink in. The goal is not just to protect your assets. The goal is to convert your personal income and business income into trust income that can be legally deferred. That means that your business no longer pays you personally. It pays the trust. You no longer own your LLC. the trust owns it. And because the trust owns everything, it has legitimate trust expenses, which now cover what used to be your personal lifestyle. You become a sovereign trustee, you control the entity, but you've legally relinquished ownership. Remember, ownership is the scam. Ownership is the trap, which means that you step into a new tax category entirely.
I'm just going to stop it there because I don't know. I feel like an orange jumpsuit is going to chase this guy, and he's going to get 3 hots and a cot and all that fun stuff. But eventually, they're going to catch up. But can you just kind of dissect what he just said there?
I mean, I'll start with the reason they don't teach this in school or at your CPA office or anywhere else is it's not accurate. You know, like you're not stepping into a new form of ownership. It's just reallocating. And ultimately, not only for income taxation, but, you know, he's implying asset protection benefits as well. These are things where they're saying, look, you're just going to kind of put some paper, we're going to reorganize who owns this. But ultimately, you're still the owner, you're in charge. And if you haven't changed the economic reality, the law is not going to recognize it, whether it's the IRS or your creditors. You have to have meaningfully shifted something. If you sell it, you need to get money back, not just a note that's never paid.
Well, I would just go over this. He's saying you can legally defer income. And it's the extraordinary dividend thing under 643, which does not mean what he thinks it means. He's
Correct.
saying, oh, a trustee in good faith can call this thing. And let me pull that statute back up just because these guys kind of drive me nuts sometimes. And I want to make sure I'm showing everybody exactly what the law is. Here we'll go. And so let's go. So what they're talking about is this provision right here. And what it says is for purposes only of subpart B, which is a simple trust, which means it's forced to distribute or not distribute, but it's forced to tax all the income to the beneficiaries every year. What it is saying is there shall be excluded from those items of gross income constituting extraordinary dividends or taxable stock dividends, which the fiduciary acting in good faith does not pay or credit to any beneficiary. I just want to point that out, by the way, because he's talking about, hey, you take the profit and then you live off of it. That sounds like the beneficiary received it, but you know, we'll let that go away. But that such dividends are allocable to corpus. And again, this is simply they're allocating it for distributable net income purposes. And now they're saying, hey, if you're calling it extraordinary dividend, it's not DNI. Therefore, it's taxable to the trust. Is that fair?
I mean, again, they're trying to get around by wordsmithing and saying, well, look, it's excluded from income. Well, it's excluded from a DNI calculation. And kind of the interesting part is the next subsection, tax-exempt interest, where it says there shall be included tax-exempt interest. Well, by their logic, then we're going to be paying income tax on tax-exempt interest if we were to follow that, kind of follow their train of thought there. And this should be kind of signaling to people it was tax-exempt interest, but now the trust has to pay tax on it.
It's included in the trust calculation for income. So if it's excluded, then it's excluded. If it's tax-free, congratulations, but the trust still is recognizing that income. Guys, that's all this is saying, is who pays the tax. If I am the trust and John is the beneficiary, what they're saying is, hey, how are we allocating the income between Toby the trust, and he's paying tax really horribly, and John, who might be getting a little bit of a better deal, but a trustee is sitting there saying, hey, I'm not distributing this out to John, I'm going to keep it in the trust. That means it's taxable to me, not to John. If it's taxable as distributable net income, then it's taxable to John, not to me. That's all it is. It doesn't mean that it's magic. Doesn't mean it's not taxable. It just means that it's that little nuance that these guys never seem to want to look at. Here, I'm gonna play one more. I call her. I shouldn't say what I call her, but she's dispensing some very interesting advice. So let's listen and let her words do all the the talking.
U.S. investors, never again pay dividend income taxes on any of your profits again legally with the spendthrift trust. It's legal. It's in the IRS tax code 643B. Personally, I work for a private law firm that was started 77 years ago by a Harvard law professor. He wrote 5 specific trusts to save specific taxes. The beneficial trust is for all investors. You'll no longer pay dividend income taxes on profits. You'll no longer pay capital gains when you sell something at a profit. You'll no longer pay interest income taxes if you're a passive investor. You'll no longer pay rental income taxes if you're a real estate investor. And you'll no longer pay royalty income taxes if you have talent or if you're in an NFT world. Now, dividends are taxed just like federal income taxes, between 10% to 37%, and affect you if you're in the stock market, you're a day trader, you're a futures trader, you're doing commodities trading, or you're living off of dividends. If you want to find out more, because I know this sounds too good to be true, I have a free masterclass at www.thetrustisyou.com.
All right, let's just stop that.
And again, the thought that because it's been categorized as a certain way that a trust will magically allow you to defer, delay, not pay tax now on it, it just doesn't work that way. Look, having worked for billionaire clients, they would love to not pay taxes on things. This is not something any of them are doing.
I would say this, because you just hit on something, because people say the rich do this. I work with, we do over 10,000 tax returns a year for investors that are wealthy investors. Guess how many people do this? 0. There's none. And we work with people that are in those circles. You said you had billionaire clients, 100 millionaire clients, probably a lot of very wealthy people. Do you have a single client that has ever done this strategy?
No.
Yeah.
No. And I mean, at this point, when clients come in, new clients come in and say, hey, we've got this. It's we're cleaning this up or we're not working together. It's not there's not an option on this. I can't be a part of this because it is so far beyond the pay.
Yeah, it's funny how that works, isn't it? And then when you bring that up, then boy, do they get mad.
Yeah.
And they say, well, you don't know. Here, I'm going to put up another thing here. And this is the IRS memorandum that they like to say, you can't cite it as precedent because it is a chief counsel memorandum. It is not a court case. It is the IRS literally telling you how they interpret this, this strategy. And they felt so strongly that they wrote. Do you want to touch on the memorandum and what it meant?
Right. And you were getting at the first part of, it's explicit on the, sentence 1. It's not precedential. It has no precedential value. And nobody who knows what they're doing would say that it's precedent. What it's doing is laying out the precedent that exists both in court cases and how the statutes work. And so, that's usually the first line of attack from them is, well, it says you can't cite it as precedent. Nobody is. It just like saying, well, just because somebody has laid out the logic, it doesn't mean that particular explanation is precedential. It's you look at what that support is and walk through, does it follow along? Because courts are going to follow this.
This is kind of
not because it's the memo, but because the logic is set.
But so what they're setting out, and I'm just going to highlight the summary so people can kind of look at it themselves, but they're right out the gate. This memorandum discusses a marketed trust structure that mistakenly interprets 643 of the Internal Revenue Code to remove certain trust income from current taxation. You couldn't be more clear about that. And it says, this memorandum describes the structure and explains why it does not provide the claimed benefit. This is the IRS telling you the strategy does not work. And then they go and say, but it's not a court case. It is literally the police officer saying, if you spit on that guy, I'm going to call it assault. And you saying, but the statute, it doesn't talk about spit or, whatever. There's an exclusion as to whether it's a misdemeanor or a felony, right? And they're trying to argue that. And it's it's still a crime, my friend.
Still a crime.
Still a crime. And
you could still get in a whole lot of trouble.
And people keep saying that you could do it. And so they're saying, hey, by the way, if you spit on somebody, we're going to arrest you. Oh, but that's not a court case. I'm just telling you, the policeman, the IRS, who goes out and collects taxes for the Treasury, is saying, you're wrong. Quit doing this. and then we'll talk about the ramifications as if they catch you. And again, I like this. For simplicity, this memorandum is limited to rebutting the promoter's misinterpretation. We do not address whether some of these structures could be recharacterized as grantor trust. So in the very beginning, we talked about, hey, we think this is probably a grantor trust. It's not going to be, it's going to be ignored anyway. What this is saying is, hey, we're just saying you're wrong here, but that's not the only argument we have. We could also say it's a grantor trust because you're maintaining control. Now, John, what happens when they catch up? Because I've heard these promoters all say, if it was wrong, they would have arrested us by now. Or if it was wrong, they usually say that there's a court case, which then they try to cite, which isn't actually a court case, and it's usually made up, or it means something else. Or they say, we've never, we all of our clients are doing it, therefore it must be okay.
Right.
What ends up happening?
The court cases that usually get cited are, well, yes, the trustee has the authority to allocate between trust and income and principal or corpus. I don't disagree with that. Ultimately, the IRS doesn't care if it's allocated to trust, income, or corpus, because that just tells them who is going to be paying the tax. But this is one of the difficult things of, people may be doing this, and because of the way that the IRS processes returns and the way things are enforced, people can get away with this. They can get away with it for a long time.
Until they don't.
Until they don't.
And so I'll put this up here. Here's a case. I think you're familiar with this.
Yes.
This is what happens when you do it wrong. And what happened here?
And not only did you do it wrong, but failed to heed the warnings of people telling you, this is not a good idea. You probably need to stop. And over being told. And at this point, I forget the exact numbers, but there was, $41 million in restitution that needed to be paid. He's going to jail for 12 years, I think.
So, and in full disclosure, in this particular case, the partner of this guy, or somebody who was a co-conspirator, was one that I had interacted with, and that ended up, got to discuss with CID. They actually had my email to the guy where, like in a lot of cases here, there's an attorney who said, like as one client put it, my attorney said it's tax evasion, I could go to jail. And there was other that he wrote to them that this was an illegal structure. So I had written to one of the co-conspirators here that this was illegal, and what you're teaching was tax evasion. And of course they ignore it. And then they all got prosecuted. And there was a lot of folks in this particular case. This particular guy was a plumber, I believe, and he was getting other people to get involved in this. And so what do you get? 12.5 years, so 12 and a half years for promoting and selling a tax shelter. So these guys will eventually get it. It sometimes takes a little while, but that's they get hit.
Yeah, this is the hard part for us coming out and saying, well, look, this is a problem. We don't get these cases all the time. It's hard to say, well, look, it could happen to you, when the reality is not every case is reported. If these settle, you're not going to see necessarily a press release on somebody settling. If they get prosecuted for something outside of the IRS but related, you may not see it coming up as, well, look, 643 wasn't upheld. So there are plenty of reasons why we may not see an explicit case on this. It doesn't mean that the logic doesn't work. And that's not the proof. Again, we're asking for, where is the case where this has been upheld? One case. Because the IRS clearly is going to fight you on this, because they've laid it out. It's on their website. They've got the memo.
I've never seen one.
Yeah.
Have they ever provided?
I keep asking for one.
Yeah.
I would love to see one.
And there's lots of folks that have gone to jail for this. We've had a number, like it's just, you can just kind of Google tax evasion trusts, and you'll see that the number of folks have gotten popped. And I remember early in my career dealing with a group of doctors where a bunch of them ended up going to jail because, they all kind of went in and followed a guy that was like the cowboy hat guy or that lady or stoner guy, and they all, hey, this is, this works and all this stuff, and then they all ended up going to jail. So that's the question: what happens
Too
to
good to be true.
taxpayers who follow this advice? Because it's not like you get a get out of jail free card just because you listen to somebody else. What happens?
Yeah, but if the IRS finds you, that's the problem. When they find you, then you're in trouble, because at that point, even if you think it worked, one of the first things that they're going to bring up is, this is too good to be true. You're telling me that just because you thought you didn't have to pay income tax on this, this is where ignorance is not going to be your friend, and that will get tossed in front of you. So the alternative, if you've been doing something like this, is to go in, because the IRS has, while there may be specific programs that have different names for particular problems, voluntary disclosure is a concept, and the IRS would much rather you come in and say, look, we're sorry, we fixed it, get the blessing and go on. They would much rather have you come in and kind of sort things out before.
I've dealt with this where a client came in and they realized that they had been scammed. In this particular case, it was an offshore thing. And thank goodness it was, so they talked to somebody who said, hey, this is where it's wrong, amend your returns. And there's not a statute of limitation when you're committing these types of things. So in that particular case, it was, they bucked up and they paid up. And right when they were doing it, an audit notice came in. And they were able to show that they had already started the process of rectifying it. And that's what kept them from getting into hot water with CID. They were able to do it civilly, which, by the way, just because you did this and you turn yourself in, or you go in and you say, hey, I made a mistake and I was following somebody and I think that the advice was wrong, it doesn't mean you don't pay the tax.
Right.
You're going to end up paying it plus penalties and interest. The only question is whether you're going to go to jail as well.
Right. When I've been involved, throughout my career in cleanup, you're always going to pay the tax. That's never a question. The penalties are what penalties, not just financial, but criminal time. Mm-hmm. That's what you're hoping to avoid. Interest, you may get away with it, You may not have it enforced depending on what's going on. Look, we're sorry, we figured this out. Here's everything. And you ask. And depending on who you get and who you're working with, those are still humans. I know it's easy to just kind of turn the IRS into a faceless monolith, but it's still humans who will listen to you.
Yes. And now let's be real. You're watching this. Again, put in the comments if you've been pitched one of these, if you know anybody that has, get this in front of them. Because now, if somebody has been pitched this, what should they do? If they've actually taken steps, what should they do? If they're seeing this, what can they do to protect themselves and the rest of the public?
I mean, the first and easiest thing is don't do it. There's not a version of this. There's not a new explanation that's going to come out that will make this work. If you've been involved in this, then getting to people who know what they're doing, CPAs who actually prepare returns for trusts and know how to clean this up, potentially a tax litigator to walk you through the process of cleaning up things with the IRS. And then finally, someone like me, I don't do the tax litigation. I don't do the income tax returns, but where I get involved, I'm here because you have a real trust for state law purposes. You're going to have to unwind this or turn it into something. Well, reading through, what can we do with this trust? How can we make it work? How can we pull things apart without violating the fiduciary duties that this irrevocable trust has imposed on, or you've imposed on yourself?
So you bring up something, because I've heard some of these influencers say that it's common law. They use the sovereign buzzword and things like that. Is there any situation where state law is somehow going to trump federal law with regards to taxation, where you can actually just have a trust document that says, by the way, I'm going to give the trustee the ability to say this is not taxable because of some fiduciary accounting principle? Is that a thing?
No. I mean, again, when it comes to federal taxation, those taxes are going to be paid. There's not a trust agreement that you're going to draft. And beyond that, there's not something that will allow you to draft a trust agreement that doesn't get around state law. Because while there is common law, every state has its own statutes that govern how trusts are interpreted, and trustees know what they're doing, beneficiaries know what they're entitled to.
Fair enough. All right, guys, I think we've smacked this topic around enough. If you're out there and you're still going, I don't know, I really think that cowboy hat guy, stoner dude, and crazy lady are the real deal, and you're not going to listen to a couple of lawyers. I've been doing this for close to 30 years. John, you've been doing it for quite a while. And I'm just going to go ahead and I'm going to ignore the IRS telling me that explicitly that what I'm doing is wrong, and I'm just going to do it anyway. You're on your own. But if you're somebody who has some logic, go ahead and put your comments down below. If you have questions, legitimate questions, go ahead and put them down below. John, I'll put your contact information in the show notes in case they want to bounce something off you. Or, again, if it's somebody who's considering advanced trust structures, make sure you have competent legal advice. A lot of these folks, they're influencers. They're not attorneys. They're not accountants. They always steal somebody else's credibility. I worked for a lawyer who did this for 70 years. No, you didn't. That's absolutely untrue. Sorry. No. I don't know of anybody who did that for that long, had practiced trust law for 70 years. I wouldn't want to do it. Right. But that's not a thing. In any case, you might have lawyers on both sides, and guess what? Neither one of them is probably right 100% of the time. The law is what is correct. And the laws in here, it's not up for some sort of bizarre interpretation. It is what it is. It's black letter. Congress wrote it. This is how it's used. And some tortured interpretation doesn't get you away from actually paying tax just because you think, hey, I think these words mean this. And if everybody else is saying, no, that's not the case, then choose that path at your peril. Again, if you know somebody who's been pitched this, share this video with them. If you've been pitched this, reach out and get competent legal help so that you can make sure that you're going in and getting yourself out of the bullseye, so to speak, so there's not a target on your back. John, is there anything else you want to finish with?
No, Toby, it's been a lot of fun. Obviously, there's a lot to talk about here. Lots of other ways that we kind of hit on, but we don't have time to get into on how these can further go astray.
Perfect. Well, I'll have you on again. We can go over some more fun stuff. I have a feeling that there's going to be more activity with the IRS on these as these folks get brought to justice. But thank you for coming in and sharing your time.
Oh, great to be here.